Do you think that the interest rate is the key thing, the key metric that we should be looking at? Are there other outside factors that we should be looking at that can create a soft landing inside the economic side of things?
I mean, of course, inflation is something to look at. Other key things to keep an eye on when you think about the economy is what's happening to business investment, because you need in business investment to keep growth going. You can watch the labor market, see what's going on with job openings, the quits rate, what's happening to wage increases, gives you a sense of what's going on in the economy. Unemployment rates, kind of a lagging, coincident to lagging indicator. So obviously the most important thing for real estate values is jobs in the location from where you can work from that house, right? And it used to be very easily to define given commuting patterns. Now with remote work, it's a little bit broader what it is. But the key thing is employment growth, right? And that'll support rental housing, owner housing, both those supported by employment growth.
Do you believe that there are any situations in the next 5 years that we see a 2 to 3 in front of the number on a percentage rate? Is there any lever that puts us in that situation over the next 5 years, let's call it?
Well, in my opinion, I think we would have to have another a black swan event. A black swan event is an event that it's unpredictable, right? Like COVID was. So you would have black swan event, something very unpredictable shock to the U.S. economy, or some external shock, maybe in terms of like a war situation. Our economy slows very considerably to where the Fed has to drop the rates to essentially zero. I mean, it would have to be something pretty bad.
You know, I agree. I mean, you think about it, and with your question talking about Fed rate cuts, something to keep in mind is that mortgage rates, I know a lot of people in the room are probably borrowing at shorter rates versus someone who's buying a house, taking the mortgage rates up. So the shorter rates will probably continue to come down if inflation continues to come down and the labor market is doing okay. So you could expect that your cost of borrowing is going to continue to come down over the next year. Mortgage rates going back to 3%, that would mean the bond market thinks that there's no inflation and there's not a lot of growth, or there's just an outright deep recession.